listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
Yes, sit back, enjoy the show. Today we are talking about refinances. Everybody's been hitting us up. We've got Salvatore Cruzmano, Brad Weisgerber. We are Inside Real Estate. We have spent a lot of time over the past few weeks talking about the mortgage industry, and we're going to get back to obviously our real estate partners and real estate in general and talking about that. But because of the market the way that it is, I believe that it made some sense to talk about refinances because we're getting a lot of questions about refinancing. So before we get started, obviously, thank you for subscribing. Thank you for following us. You guys are awesome. You know, whoever listens to us, all like 15 of you, we really appreciate it. So go wherever you can find us, Google us. So, you know, it's crazy, Sal. I know you're busier. Sal, so just so everybody knows, Sal does a lot of originating. He's kind of a machine. And generally speaking, we've been a purchase dominant type mortgage shop, but recent events have caused a kind of a change. Not a change. We're just getting a lot more refinances than we had anticipated. And so I want to talk about that today. I also want to talk about some myths about refinancing, and I also want to talk about be careful with the clickbait that's out there. Because Sal, you know this, dude. It's like, oh, I saw 1.99 on blah 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 blah. You know what I mean? Or I walked to my bank and they're offering this and that, right? So there's a lot of people that are like going for the lowest rate, but ultimately, like, it's a lot of it's clickbait. And can you explain why it's kind of like clickbait for people to like look at that and not realize what's really going on?
Well, yeah, I mean, if you think, can you hear me?
Yeah, we can hear you.
Okay. If you think about it, I mean, a mortgage itself and the rates and the market are far more complicated than I think the average consumer would understand, right? So, yes, you can get a 1.99 rate, but there's cost behind it, right? So, I think that when people think that they can just lower their payment, they don't really realize that, you know, these companies are basically targeting them, saying no cost, no points, or well, not no points, but a no cost or no cash to close refi at 1.99%. They're essentially rolling in, you know, thousands and thousands of dollars worth of costs, and that may, in the very long run, make sense. But you know, people often don't think about what they have coming up in life, right? Like a potential move. Are they going to have kids? You know, that mortgage isn't going to last 30 years. So you really have to do the math. Sorry, I got something in my throat. I need to go get some water. But
Sally, let me just cap it because I think you're right. I think the reality is like the general consumer out there wants to say, I got X rate, and they want to wear it like proudly and like basically say to people, oh, I have a 1.99. The issue with that is, and it's not that it doesn't make sense to pay points right now potentially, but it doesn't make sense to get a 1.99 just to say you got a 1.99, but it costs you 7 points.
A refi is about saving money usually, right?
Right.
Or taking cash out, obviously, but for just a regular rate and term refi, which is what most people are doing right now. Yeah, you can save money, but at what cost? I mean, that's all you got to ask yourself. You can save money and go from like a 4% to, let's say, a 3 1/8 for absolutely free. That's a no-brainer, right?
Right.
You're saving money every month. But these rates advertise at 2.5, 1.99, whatever. You will absolutely pay for that, and that's not going to be something that you'll be able to recoup for potentially 7, 10, 12 years. And I mean, we priced one out yesterday with 6 points. So,
right.
You know,
right. I want the consumer to understand what's happening when you see this stuff. So the mortgage industry is really big on generating leads because what they have is they have these call centers and they have to find a way to get you on the phone. That's really the driving force. So the biggest, most important thing, what happens is when you click that 1.99, Sal's gone. They were 99. Yeah. And they just want you to click on their form and fill out your information so they can call you 45 fucking times all in a row and then get you on the phone and you realize, yeah, 1.99. But if you get a good loan officer on the phone, it's a crapshoot, but it's all about generating leads. That's what it is. People are getting funneled into a database where people are just calling. And there's nothing wrong with that if it's done respectfully. But dude, like, would you put your information in LendingTree right now?
No, never.
Why wouldn't you put your name in LendingTree right now? Why? Why wouldn't you do that?
I've been on the other end of that. The people that are calling, and I've heard the frustration and the horror stories of the people that do that, right? They put their name in, put their number in, they put their email address in, and 1 second after they click submit on that webpage, their phone is ringing, and it's ringing nonstop for days and days and days and days. Their mailbox is going to get full, voicemail's full, email's full. They're going to get text messages. They're going to get blown up to the point where they want to go throw their phone into the lake and hide in a cave. It's brutal.
So I was on the other end of that. I was the guy calling for many years.
I was too. That's what I'm saying. I would never want to do it.
And I was really good at it. I would get people on the phone, and I did it from a place, but I got people to work with me. But here's the thing. I had to call them 45 times sometimes. And sometimes they were getting 45 calls from somebody else. And if I didn't make enough calls, I'm getting in trouble for my bosses. So my job is to make calls all day. So understand that you might get a good loan officer. I think I treated people well, but at the end of the day, it's become, because there's so much business out there. Now it's becoming where the deal is disposable and it doesn't matter anymore. Customer service is going to fall greatly if you just go for the lowest rate, because they're just trying to do as many deals as possible. Wouldn't you say that, Sal?
Yeah. I mean, it's like, companies are just putting a big net out there because the fish are in the sea right now, right? There's tons of them. So essentially, you could walk down the street.
You're shooting fish in a barrel, dude. You can trip and fall on a mortgage.
Anyone can refi right now, basically. People who refied in March can refi. And it's almost, you got to look. It's like, all right, you just refied last year. You refied again. Obviously, you want to take advantage of this lower rate again, but what's it all going to cost, right?
Right.
And at what point, and then they're like, well, it's funny. Some people who refi are like, yeah, we're selling. We're selling our house. I'm like, you literally pissed away like $6 or $7 grand in the past year trying to refi, right? And obviously, I mean, like what we were doing a year ago when the rates were still low and good, we were offering no cost or low cost refis, right? But right now,
almost every time, because it makes sense.
But right now the rates are so low and the margins are so thin, right? That people are paying costs because this could be the last refi they do.
Yes.
Right? So at that point,
if you're going to be in the home long term, there's no problem, in my opinion, buying points right now because you won't have to touch it again, right?
Not even buying points, but just paying a typical cost as opposed to getting a free loan.
Between deceptive advertising, right? And not to mention, I think the biggest thing is the media, right? Rates drop again, rates drop again, rates drop again. I mean, they got some guy who's just, essentially hearing it from someone else, right? Dictating that. And I mean, rates are definitely all-time lows right now, but like if you're at like a 2.99 and you want to go to a 2.875, like forget about it. You're good.
Yeah.
Yeah.
But I think the biggest thing they're also all-time lows. They're all-time lows if you have like 720 or above credit. If you have 680 or below credit right now, you're hammered with, nobody wants that paper right now. So that like the risk is higher on those deals. And it's just, if you're well qualified, yes, you're going to get a really good deal. And even if you're marginally qualified, you're probably still going to get a better deal than you had, right?
Yeah. I mean, listen, again, for the most part, anyone can refi. The problem is the people who can't refi because of COVID, right? Whether it's reduced income or additional self-employment guidelines, like they're going to be left in the dark, unfortunately, probably by the time the rates come up, because that's what I'm thinking is what is the long-term effect of what caused this low rate situation to begin with, right? And it's essentially, I mean, I thought rates are going to be like 6% right now, right? But COVID happened, and that has bigger implications on the mortgage market and the MBS prices than potentially the low rates. Because, you know, again, it's not like and mind you, it's caused its destruction, but still it's an event, right? Something that had happened, a health event versus fundamental cracking or crumbling of a whole system, right?
Right.
So it's going to be interesting to see what happens after Corona hides its face, essentially, right?
Yeah. Yeah. By the way, if you guys are listening on Facebook Live right now, we'd love to hear your comments. Just put it in the comment section. If you have questions about the refinance market or anything like that, or anything in general, go ahead and just post whatever you want. We'll try to answer the best of the ability.
The biggest factor pushing refis right now is, well, besides the rate, obviously, but allowing them to be conducted easily and quickly are appraisal waivers, which it's like 90% of the loans are getting them with any equity, right? And
there's a lot of, even without a lot of equity, there's a lot of appraisal waivers.
And it seems like
Fannie and Freddie, the audience what that is. Before we go any further, so the appraisal waiver is basically you put the information through Fannie Mae, and they basically come back and say we don't appraisal on it. It doesn't matter, but we'll accept the value. It moves things along.
Essentially, what I tell everyone, like Fannie Mae and Freddie Mac have basically like an algorithm, right? And you put in the data inputs of the client, their credit history, their income, their address, right? Their assets, everything. Fannie Mae will analyze it, and depending on the risk profile and the location of the property, give almost like a range of what it accepts for the value. It doesn't tell you what the range is, but I mean, people who bought a home for, let's say, like $450,000 2 years ago are getting them at like $600,000 right now. It's crazy. Their home is not worth that.
Yeah,
right.
But
no,
it's wild. I mean, Fannie and Freddie have for years now. Every single appraisal that gets done on a loan that they get, which is a massive chunk of the mortgage market, they get the mortgage loan at the end. Every appraisal that gets done on these properties gets run through their systems that collects all these data points on every single appraisal for every loan that they have, and they've been doing this for years. So they have a plethora of data.
Their data set is crazy
by zip code. Like it's insane how much data they have. So they've been able to fine tune kind of their value, I guess, margin. When you run a file, like Sal said, through their system, they take a look at the zip code and then all the aspects of the file and give you kind of a range of what they'll accept based on all the data that they have for years and years and years now. It's crazy.
Yeah. So let me ask you this. So if you're a consumer today, guys, I mean, we could talk about all the back end stuff. There's some what is that? I just refinanced for you guys. It was great to the help. Also, Paul, does Tiff know you wore her shirt to work today? Thanks, Hawk. I appreciate that. That's a little off topic. So, I
think he's calling you small.
Do
you even lift, bro?
Some cute.
Man,
you even lift, bro? Look at Sal just got it. So, if you were a consumer today, you're out looking to refinance, with your knowledge base where it's at, what would you look for? Are you looking for the lowest rate? Are you looking for a bank? What are you looking for if you didn't know Omega Lending existed?
With my knowledge, or assuming I'm a regular consumer?
You're a consumer, but what would you want in a mortgage company?
I'd be looking for a loan officer that knew what he was talking about, he or she was talking about, right? So I'd almost be interviewing loan officers and asking questions like a job interview.
Kind of the problem, I mean, you don't know what you don't know, especially in a complicated situation. So I think you just have, I think as a consumer, like either get a good referral, right, from someone that you know.
That's probably the best way.
Like be able, like somewhat savvy, right? And maybe call a couple places, see what they got to offer, because people just think, oh man, I've refied 3 times. I was started at a 5 and now I'm at a 3.75 or whatever. What would it cost you to get there, knowing that potentially yeah, me and my girl are getting married or whatever, and we're gonna buy a new house. Well, you should.
Is that an announcement?
No.
I'm just kidding.
But yeah, I mean, people just gotta think about it, and I think that's the biggest misconception is timelines. People don't realize that,
I think they have to think about that, like you said, but they also have to ask questions. They can't be afraid to ask questions. What does this cost mean? What does that mean? Is this the best thing you have for me? Ask the questions, because you don't know what you don't know. If you don't ask the questions, you're never going to find the answers, and you could be in a really bad loan.
Yeah. I mean, I don't know how many friends of mine have like sent me loan estimates and been like, hey man, how does this look? And I'm like, I'm getting capped out by my boys on our show. John Caruso said it's getting tighter by the second. Okay, great. This has really gone off the rails. So I guess my whole point is it's like you got to find a company, in my opinion, or person that you trust, that you actually get good advice from. There's a lot of loan officers out there, dude. It doesn't matter who you call. You might call a bank and get a really good LO at a bank. You might call a broker and get a really shitty LO at his broker. You know what I mean? It's also the quality of the person individual, but then what's the company behind it? Do they have a good reputation as well? Like, do they have a good reputation, and are they so big? Like I'll be honest with you, Quicken Loans retail, if you go to Quicken, they have some of the highest rates in the market, period. They always have. When I worked at Quicken, I'll answer that in a minute, Joe. So keep that up. When I worked at Quicken, I was selling the highest rates in the market, and we were doing 20, 30, 40 deals a month, right? And because they just sold better than other people, but that they're very transactional, right? But people think that they,
like, it's easy to a degree, like with the refi, for something to make sense. Like, yes, you're saving $120 a month, not knowing that at another place you could save for the same price or same cost.
That's exactly what it was, dude. Hey, right? I'm saving $300 a month. Let's do it.
Yeah. And that's easy to say yes to. And I mean, as long as you're not jacking their points and whatnot, if that was at the time something good that you could offer someone, you help them out, I mean, so be it. I mean, there's lower rates everywhere, right?
Yeah. So Joe asked, why are points worth paying in a refinance in today's market? I'll give you my opinion.
Paul, first, I think you should answer Kevin's question before you answer that one, because it kind of leads into it.
Kevin's hot. Okay, since I blasted Paul, I'll ask a true question related to Joe's previous question. What exactly are points, and how do they affect consumers when refinancing and beyond? That's a great question. So points are basically prepaid interest that you pay up front, and they're called discount points because ultimately you end up paying upfront interest, which will discount the amount of interest that you pay over the life of the loan. So when you pay a point in discount points, it's 1% of the loan amount. So if you have a $200,000 loan, it costs $2,000 to buy a point. The misconception is that if you buy 8 point, your interest rate drops 8%. Those are not analogous, they don't coincide like that. 1 point might just bring you down an eighth potentially. I mean, sometimes not even an eighth. Sometimes it's like 1 1/4 to go down an eighth.
Well,
right?
It's often not static between the different rates as far as what the points cost. So it's kind of market driven, but essentially, you're hedging your time in the house to a degree, right? And you could just do a quick break even analysis. If it's buying 1 point on a $200,000 loan, let's say, costs $2,000, and it saves you $20 a month, you won't see that money making sense essentially for 100 months to a degree, right?
By the way, it doesn't save you $20. It's less than
right.
That,
Sure, but you know what I mean. It just depends. Yeah, it's a matter of how much more is that buying your rate down, and sometimes it makes a lot of sense to buy points because maybe that rate that's just a little lower, maybe that rate that's lower is only an eighth of a point or a quarter point or whatever it is, but ultimately, that's just something you have to ask your loan officer about for options. What's it look like if I wanted to buy down an eighth of a point, a quarter point in rate, a half a point in rate, and what does that cost me up front? Okay, well, the difference in payment is X, it costs Y, so essentially Z is the time frame for it to take to break even, right?
here's the only from usually. So I was very big on doing no cost refinances because if you take a little bit of a higher rate, you absorb all the costs, and there's no cost, so there's no recoup time on it. Then if rates come down a month or a year, or 6 months or a year later, you can refinance again. There's no recoup time.
To your point, yeah, if you go higher in rate instead of paying points, you get credits, right? Lender credits.
Exactly.
So, you could take a high rate, pay all your closing costs, let's say on a purchase, and if rates are lower in 6 months, refi out of that loan for essentially no cost, and you just,
because if you paid costs, just so
dollars in your
everybody
pocket.
understands, if you paid costs and you refinance in 6 months, well, you just paid a penalty for that refinance because you paid X amount of dollars for a lower rate, whatever it is. So, but the reason, so Joe, the reason it might make sense now of all times, I think it's a very specific person, and it's rare because if you were to pay points today and you said, I'm going to be in the house long term, this is my forever home. Paying points doesn't matter. You can use the equity in your house to pay the points, which is basically using fake money. You could roll it in, you pay some interest on it, but you have the lowest interest rate. And even if it takes 5 years to recoup those costs, then it's feasible because you're telling us you're going to be there long term. The reality, though, is most people don't live in their homes forever, and most people shouldn't pay a lot of points if the recoup time is anything longer than 3 or 4 years, in my opinion.
It also has
you
a
just
lot
got
to
to do the math.
Effective though, Paul. So it could make sense. Alternatively, if you're looking at dollars and cents, bottom line, right? But it could also make sense if you underpaid for your house and your home has appreciated significantly. You're basically using your gains on the house to buy a lower interest rate. So it could make sense that way, regardless of how long
you're using the fake equity.
So it's all monopoly money to a degree. So it makes sense to different people, and that's why you have to talk to a professional to find out if it makes sense for you.
Yeah. You want to know, you've got to have someone break down all the options. The way that I always did it, and I don't know, I think Sal, you do the same thing. Like on a refinance, I say, okay, if I were in your shoes, I do X, but there is an argument to do X and Y. Up to you what you want to do, but this is what I would do in your situation. I think that's the right way to do it because there are so many different ways to structure a refinance.
Right. Yeah. I mean, I think, again, it really comes down to like, what are your personal plans, right? Do you see, well, we might list in the spring. I've had a lot of people call me, they're at a 4.75. Of course, it's a no-brainer to refi right now, but we do the math and it's like, I don't think that makes sense. I mean, You're going to pay X amount in interest and fees. So why would you do that?
Yeah.
Right. So
it kind of goes into John's question. If I refinance, how long do I have to stay in the home to have it make sense? If you do a no cost refinance, the savings are immediate. If you don't go backwards in the mortgage, let's say you've got 26 years and you did a 30-year mortgage. Well, you wouldn't want to do that if you're going to be there short term. But what I would do is I would do a 26-year term or a 25-year term, save X amount of dollars over the next year, 2 months, 3 months.
But I would do it at no cost, right? So
do it at no cost,
that
right?
275 or 2875. All right, let's do a 3 or 3 1/8. Which, mind you, too. I mean, in this market, some of the lowest rate lenders have stipulations too as to where the loan was before. If it was with them already, you can't refi it because one of the things that kind of got people into trouble was churning, right? Just churning their loans and churning the books because these investors are expecting these loans to perform anyways, right? So
they have these are going to perform. These will be the best performing loans of all time. This is why these loans are so just so everybody understands, when the servicer buys these mortgages on the back end, if you refinance in 6 months or a year, that loan that did not perform, they lose money on that deal. But now this paper that's being drawn up now, it's going to be,
albeit at a lower return, right? But a longer
they're going to perform.
Right? Yeah,
for long term. These are going to be long term mortgages people are doing. People aren't going to refinance out of a 3% rate to get 2.75 probably, unless they have a huge mortgage, right? Even if they go a little bit lower. Oh, how do rate locks? Okay, sorry, we got a question from Chelsea. I hope I answered your question, John. I think if it just depends on your structure of the deal. How do rate locks? Chelsea says, how do rate locks work given today's volatile market? That's a great question, Sal. You deal with this all the time, right? Every time it's like, man, the market's good, should be locked.
Yeah,
right?
it can go it can go one day or the other, one way or the other. I mean,
1 minute
there
or the other, bro.
there are options for float downs, they call them, where, hey, if, let's say you locked in at a 3% and rates go to 2.75, you can take advantage of that, or even maybe 2.875, depending on the lender, right? You can go down for the same cost as long as the current market conditions kind of meet what you did, right?
But it's not ideal. That's not the ideal way to do it, really.
But with that being said, it's also difficult too, because turn times at lenders have definitely gotten longer too, and some lenders only offer 22, 25-day locks versus hedging it out for, we know we're going to need 35, 40 days on this.
Explain that second so people understand. So just so everybody understands, that might be a layman. So when you lock in your interest rate, we as a lender lock that rate in for 30, 45. You can even do 15 in certain instances. But in today's market, we have certain lenders that only allow us to do let's say a 20-day loan, which means we can't lock it immediately, because that loan will probably take, depending on the loan, 30 days or 28 days. So not knowing what
another thing that people got to think about time-wise is there's a 3-day right to cancel that needs to be covered in that rate lock too. So it's called the right of rescission. And basically, if you close a loan on Monday, you have till, midnight on Thursday to cancel the loan, right?
Yeah.
So that time
you can rescind the loan. Yeah.
Right. Even if you signed everything, that loan doesn't fund until Friday, and then it's paid off, and then it's final. So, that's basically a week of your rate lock. So, and it costs more money to lock a rate longer, right? Or more points, or a worse deal for you potentially. But in this volatile market, it might make sense to answer your question. It might make sense to lock a 45-day, knowing that underwriting is going to take longer, knowing that maybe it's a deal that's just perfect. It's the bird in the hand per se, right? Versus, well, let's not lock. Let's see if it gets better. Let's see if it gets better. And then all of a sudden that sweet deal you had is just an 1/8 of a point or a 1/4 point higher. You kind of lost out gambling.
Yeah.
I would say rate locks work the same way as they always have. Once you lock your rate in, you're locked in for the specified amount of time. But the difference in the volatile market is you're seeing shorter lock periods being offered because it's volatile. So they want to hedge that as short as possible to make sure they can get their return back on the back end. And it's getting a little more expensive to do the longer locks, and they're getting really snappy with repricing locks. So if something changes at all in the market, you're seeing pricing get suspended, new rates coming out quicker than before, because everything is so tight, margins are so small, and the market's so volatile. They're really watching it and really quick to pull the trigger on suspending pricing. And so a rate you got quoted in the morning could cost different in the afternoon. Well, that's just the reality of where we're at.
And typically what people look at are treasury bond yields for where the market's going rate-wise, right? And what's interesting is, 2 or 3 months ago, they were lower than they are now, which would typically indicate a lower rate, but the rates have come down since then because of all that hedging that the lenders have been doing to account for their losses. Now the margins are getting thinner, and you are seeing a lot more, like you said, reprices, rules on locking. Some places are loosening up, some are getting tighter. It's just, it's an interesting time, and I think as long as these remain low, everyone is going to be really busy. And I think that's something as a consumer you have to understand, like the whole entire housing market essentially can do refinances right now. So it's not like before where it took a week and a half to close from start to finish to close your loan. We're now looking at, potentially, depending on the lender, like 2 weeks in underwriting, right? And it's normal. It's not like you have to close on this home or whatever. Just, be patient, because lots of people are working on lots of loans right now.
Yeah, there's a capacity issue big time right now. And if you're, I want to talk about, I want this part of our show to be what borrowers, what people, what consumers should be looking out for when they're speaking to loan officers to try to figure out what's going on. And I want to talk about some common things or common things loan officers say that is bullshit. That it's common, but it's bullshit. There's a lot of bullshit that people talk about. Like, honestly, like, think about this, right? when someone sends out a cost worksheet, why is that a bad thing? Why is like when someone sends someone a cost worksheet, what does that mean? And when they say this is the rate they're giving me and it was from like 3 days ago, what is wrong with that scenario?
It goes back to what we just talked about with the volatility in the market. The pricing can change from morning to afternoon, from 10 o'clock to 11 o'clock. So if you're getting a quote with prices from rates 3 days ago, imagine how much the market has changed. That is not a valid quote anymore. It might be a ballpark, but it's not even close. And a fee worksheet is not a binding document at all. They don't have to honor any of those fees. It doesn't mean anything. It's something that they can type up themselves to make it look however they want to look. It's not standardized. It's garbage. Loan estimate is an official document that's regulated. They have to stand by those fees that are on it. And if you get a loan estimate, it's maybe a little more confusing than a fees worksheet, but it's actual numbers.
Yeah.
I think people need to, if you're serious about it, knowing how busy everyone is potentially, right? I mean, if you're talking to a good loan officer, they're probably pretty busy, right? So with that being said, like I just tell people, like, listen, if I could tell you numbers roughly all day, but if you really want to do this, let's do it so I can put it on a loan estimate, and then you'll see all the fees, everything.
Right.
And they're it's federally mandated that if you want to lock that in for X amount of days, that we could do it that day, right? So that's kind of the long and short of it. Like, listen, if you're serious about it, I mean, all it costs you is a credit pull, which, you know, I think there's a big misconception about that too. Like, it's not that big of a deal to get your credit pulled. Not
that big of a deal.
What is your credit for? You know, just to wear a pin on your sleeve saying what your score is. I mean, you use it to save money by refinancing or to purchase a house or buy cars or get credit cards, whatever it is. So use it to your advantage. I mean, if you have bad credit or you're scared about it, then, you know, go to church. I don't know. I mean, you gotta figure that out.
Right. You know, another thing that consumers do a lot of is they want to shop for the best rate. I get it. I totally get it. You don't want to get screwed. You don't want to just get they should. But here's the problem with that, Sal. Here's the problem.
But pick
they
one.
Shop
quickly.
for a mortgage over a week and a half period, and the engineer's got a spreadsheet with all the different rates, right? And my rate today was different than yesterday, but you talked to me today, and just because my rate was lower, their rate's probably lower too.
Well, listen,
but you talk on Thursday, right?
If you're talking to someone, or if you're comparing lenders, and one of them's able to quickly snap you out numbers, or like, here's what the rate is, right? And the other one is like, well, let me get back to you. I'll let you know by Thursday. Yeah, I mean, you're not going to be doing very well with them, right? And often people, well, I'm waiting to hear back from Chase. I'm waiting to hear back from my bank. You know, I mean, they're taking a week right now because it's so crazy to pre-approve people. You know, it's something pretty important. I think it's more important than refine, right? So, I mean, get someone who's responsive. You know, and maybe if you find 2 or 3 people like that, okay, shop, get the rate, and choose it and get it going, right? But none of us know what's going to happen either. I had someone ask me today, what do you think rates will be like mid-October? I'm like, if I knew, I wouldn't be on the phone right now. I'd be, you know, cruising on a yacht somewhere if I knew where the hell the rates are going. So it doesn't really matter, I think, as to what's going to happen in the future, because no one knows and no one can tell you with full certainty. So if a deal makes sense, I think, and it's like a no-brainer, you might as well try to lock that in and take advantage of it. And if you have a good feeling.
But here's the problem, that just so everybody understands, like, you trying to like shop for a mortgage rate from lender to lender over a 1 week period is like trying to shop for Apple stock from day to day and try to get the best price. You can't go like it. You know what I mean? It changes day to day, hour by hour, minute by minute. There's movement in the market that creates difference in pricing, and especially now with how volatile it is, you can't pinpoint it.
It is crazy right now, though, the disparity between lenders and rates, or the differences, right? So it's tough, you know, like it's tough to tell someone, like, you know, I know, like, at least from where we're coming from right now, often if we're offering a good deal, and if we're not, because of, let's say it's like an investment property or cash out, I might say, hey, call your bank.
Hey,
you know, and if they can give you, because I think that it might be more expensive than them. And if I get a call back, great. If not, I feel like I did the right thing because, you know,
always. Yeah, that's the difference. We're not
like that's extremely rare to find.
Rare because you're turning away money, but you're doing it because it's the right thing to do, right?
Yes.
Another bullshit thing that lenders do is like if you like see if that lender is advertising an interest rate, I think that's just such because how you're just getting people, you're tricking people with this number because everybody's so conditioned to go after that number that they're like 1.99, right? So like, how can we advertise a rate when they move that dramatically from moment to moment? I'm just lying to people at that point. You're just lying to people from a day to day. Like if you created a whole marketing campaign around an interest rate,
about nothing,
the problem with mortgages is, I just really want to finish this. The problem with mortgages is there's nothing else to sell from a marketing standpoint. People can't be creative enough to like sell reputation or something else. It's got to be rate because that's all. We don't have a product. It's not tangible. It's not like Instagrammable. Like I can't take a picture of a mortgage and like make it look sexy. I can't like hire like a sexy girl on Instagram to like wear a mortgage around her neck. Like, you know what I mean? The marketing side is hard.
You created you created an ad that made mortgages look sexy, but we just never published it.
I did.
That was a good one.
Yeah, to your point, it's not a tangible good, right? It's money. I mean, it allows you to afford and buy tangible goods, right? At a cheaper cost than the other ones. But I mean, that's just, it's easy. It's easy to kind of,
but it's a game. So as a consumer, if you go after the interest rate and that's all you're looking for, you're going to end up, unfortunately, it's a crapshoot at that point, who you're going to end up working with, in my opinion.
Yeah. I mean, you know, you got to just look at the situation. I mean, of course, if you could have got something better, it does kind of suck, but it's almost like buying a car. It's like, man, I found this car. It's got low miles. It's close, whatever. You buy it. And then 2 days later, you find one with 5,000 less miles or an option you wanted, but you still got the car. It's still good. I mean, if you could always have the best of anything and time everything the right way, you would be some crazy mythical fucking robot. So that just doesn't exist, you know? So you just got to look at it and make sure you're not getting gouged.
So we got a question. Before I answer that question, there's one thing that consumers that we're falling into. Now, this is something that happens to us by consumers, and I don't even know if they realize they do this. But when you lock in an interest rate, you tell me as your loan officer, I want to lock. This is how the analogy that I always used to use. When you say you want to lock, you're saying you're at the blackjack table, you're happy with your winnings, and you're walking away. You can't look back because if you look back, someone else might have won that next hand and won a blackjack, right? But if you want to gamble, we'll sit and gamble. But here's what's happening now too in our market from a consumer standpoint. It's called borrower black. You lock them in, and then all of a sudden the market takes a tank. A week later, they're a quarter point lower, an eighth lower in interest rates. And they're like, well, I'm going to go. Now they start shopping you. Okay, well, I can't do much about that unless, you know what I mean? Like if you're going to commit as a borrower and tell us to lock it, understand that you're committing, like you're doing business with that person. I think it's a little disrespectful to like be part of that and then all of a sudden just shit on someone because they did what you wanted.
Well,
I mean, it might be disrespectful, but
I think that's it
is what it is, man.
Typically at that point, you know, and that's why, you know, the lenders we work with they offer float downs, right? If there's that big of a shift in the market, we can take advantage of that. It might cost you a little, but you don't have to restart over, you know, with a new lender. So, I mean, there's usually an answer to every question or every problem that comes up. Usually someone's got to pay for it, and often it's the broker, but you know, you already put the work in, so you might as well close it and do what's right for your client, right? I mean,
and by the way, the people that bug me the most about their rate and like what they saw on the news always is like my family. like they bust me out. They're like, what I saw on CNBC that rates went down today or whatever it is, right? I'm like, I'm like, all right, I'm ripping you off. I'm gonna rip you off. That's what I do.
Yeah, I heard the 30 years 3.126. We're at a 3.25.
Fuck you.
What can we do? I'm like, dude,
like, come on, man. You're my boy. You know? Like, I'm not gonna rip you off. So
My favorite.
I don't know.
I think one of
maybe
my
that's something about your relationships with them.
Yeah, I think one of my
probably
favorite,
they think I'm a fucking shitty person, right? Yeah.
one of my favorite shitty things that loan officers have done that I've heard of and experienced is trying to pass off discount points as a benefit to the borrower, like it's a discount, right? Because it's counterintuitive. Like a borrower
Anyone
bro,
who
calls,
that
does
happens all
a
the
borrower
time.
call and
know
say,
what the hell
no,
it is.
they told me they can give me 2.5% with 3,000 in discount. That's you're telling me it's going to cost me $1,500 for that. They're going to be 3,000 in discount. Like it's a good deal. A discount is not a discount to your cost. You're paying for it. It's the opposite.
Yeah. Joe's got a question. We got to get it off the screen because it's just up there. How does refinancing with a broker differ from a big bank? How does it differ? I mean, they're both mortgages. It's going to be process. That's going to be really different. It's just really process.
At the end of the day, you're still going to have a loan that you got to pay back. It's still a mortgage. The biggest difference is going to be your experience. The experience will be different. Big banks are not known to have very good experience scores, right? They're just not great at the experience, and
most people just think I bank with Chase or whatever,
right?
So I'm gonna go there because it's easy. They got my bank statements, whereas someone else just needs you to go and click 4 buttons in sequential order to download a bank statement and email it all in the 4 clicks of a button. So
yeah, I want everybody to hear this loud and clear. Chase, literally, Diamond wanted out of the mortgage business. He hates the mortgage business. He couldn't get out of the mortgage business because he's an FDIC bank and he had to offer it, but he absolutely hates. So how much attention do you think their process and their experience is getting on the mortgage side? You think he gives a shit about the experience of a part of the business he can't stand? You know what I mean? Like, he literally at one point was like, we're not doing any more FHAs. We're not, like, he doesn't like the mortgage side of the business for him. He thinks it's a waste of time and money. But anyways, I digress. Another thing that clients get screwed on sometimes when they're comparing lenders is the escrow account. So just so everybody understands, an escrow account is the money that you put into an account to pay for your taxes and or insurance when it comes due at that time. And when you start a mortgage, whether it's a refinance or a purchase, money has to be put into that escrow account so that when your taxes come due, let's say they come due in 3 or 4 or 5 months, there's enough to pay for them. And there has to be a 2 month or a month buffer on top of that. What happens is when companies send out loan estimates, to make the cash to close look less, to make the cost look less, because the document, it lumps all the costs, and part of that is escrows, and you can manipulate the escrows. I could put 2 months, 3 months, 4 months. So loan officers can manipulate that number very easily and then come back and say, oh, well, that's a standard thing. I didn't know what it was going to be. And, that's not on us. That's not our cost, right? But what you're doing now, that person's taking that paperwork and comparing it with like another lender, and that lender did it right. And it looks like they're paying more cost, but they're going to go with the other one. It's just a bunch of bullshit.
A refi or a purchase. I mean, there's one thing, two things essentially that the lender can control, right? That's the rate and the fees that they charge, right? So they might have $1,000 in application fees and a lender credit or a cost, right? I mean, yes, they kind of dictate who you have to use for an appraisal, but that's, $100 or whatever, which shouldn't sway your decision one way or another on a lender, really. But those are the things that they can control. They don't dictate the title company fees. They don't dictate recording fees, escrows, taxes, insurance, other parts of the transaction. So just be aware of that when you're looking. But that's another thing too, that kind of to Joe's question, the difference between a bank and a broker. The bank has their fees, right? Their fees are their fees and their rates are their rates, and they might be able to ask their manager to give you a discount or something. But we work as a broker, we work with 4, 5, 6, some people have 15, 20 different lenders that they can shop around to try to find you the best deal. And, lenders come up and down in rates, right? It's like, hey, one week or 1 month, this lender's hot, 1 month, this lender's hot. And if it's a good broker and they trust that the lenders that they're sending everything to, you should have a pretty similar experience amongst working with, for example, a UWM or a Home Point. Maybe it takes a little longer at one, but you should still at least feel like you're just working with that one broker.
Yeah, be aware, consumers, that if you're dealing with a company that is volume based, meaning they are just cranking out tons and tons of loans, you're going to be a number in a conveyor belt. Having someone that's going to give you much more acute attention and gives you the time that you want is also going to be very important in that scenario. So, yeah, I mean, and another thing a lot of people will do in our industry when you're refinancing is they're going to overinflate your appraised value. What happens is when look at Brad's face, it just lit up. So what happens is when you do a mortgage, let's say your loan to value, or how much you owe to how much the house is worth, is at 80%. Well, that bucket, right, 80% with 760 credit, that bucket has really good rates, right? But let's say
the pricing bucket, the pricing tiers.
Pricing tiers. Now, if you're at 90% loan to value, well, it changes quite a bit, right? But as a loan officer, let's say you are a consumer and you're like, hey, my house is worth $200,000. And he's like, well, has anything sold around your area? He's like, well, my neighbor sold like 225. He's like, okay, your house is worth 225. He's not an appraiser. He just wants to hear 225. He puts 225 in there. And when the other, let's say he calls us hypothetically, and we're like, yeah, dude, 200 is gonna be tough, but we'll do 200. Understand that if it doesn't come in at 200, here are the consequences, right? You explain them. If it comes in at 225, we can't control the appraisal. And then if you have that conversation, that's who you work with, not the person that takes your number, inflates it, doesn't have a conversation about the consequences of it. And all of a sudden your appraisal comes in low, and that rate that you shopped so hard to get now just got jacked, and you're fucked because you got to close that deal because you just went through the whole process.
And I think, as a consumer, at least on our end, like if I was calling and soliciting the past client to do a refinance, right? Or I would probably tell them that we'll front the appraisal because I believe it will appraise for X or whatever, right? So let's just say it all doesn't work out. We eat the $450 or whatever. But if someone's calling you to do that, and you were just sitting there minding your own business, and next thing you know, your credit cards ran for $500 because they thought that your home was worth $60,000 more than it is, and you could drop PMI and get this awesome rate, and that doesn't happen. I mean, how terrible is that? You're sitting there minding your own business. You pissed away $500.
That's it.
And
that's it.
That's
someone wanted to put a loan on the board,
right?
Someone wanted to put a loan on the board. That's what happens.
Question, because I get this a lot too. I just bought it, 8 months ago. Do I need a new appraisal? And the answer is yes.
Yeah. Chelsea. Yeah, but Chelsea, the actual question, read it. Let's read it for Chelsea's sake. Do you have to get another appraisal if you purchased your house in the last year? Sal, yes, you do. Yes, right?
Yeah. Well, for a
Not
couple of
always.
reasons, potentially.
Not always. Not if there's a property inspection waiver, but only in that case. Can I say one thing about this, Sal? I want people to understand when you refinance your mortgage, you're getting a whole new mortgage and you're paying the old one off, right? That old one was securitized, sold to Fannie Mae. It got like that's gone. Even if it's with the same lender, unless they held the paper, which most don't, it's going to go to Fannie on some level or Freddie or whatever it is, and they've got to repackage a whole new loan. Then they need to have proof of value, whether that's a appraisal waiver, which is issued by Fannie Mae, or an actual appraisal. But you need proof of value to get that to Fannie Mae and package and securitized, right?
Well, and sometimes the markets change even a little bit. You put down 3% on your house, you may have no equity.
More,
if the market
or more, right?
Or more, right? I mean, right now most refinances that are just a rate and term refinance where you're lowering your rate or whatever do get away without an appraisal. But if you're taking cash out, or if you have an attached condo or something of that sort, some type of unique home, often you need an appraisal. And if you just bought in the past year or had another refinance done where you had an appraisal, unfortunately, there's really not much you can do besides take that risk of ordering one, whether it's on you or the lender. I mean, it's just a requirement for Fannie Mae to fulfill a loan. Now, I mean, I wish that they would change that, because I do agree, like, hey, it was 8 months ago, right? Like, here's a full appraisal. But appraisals, you could get an appraisal real quick done today on the same house by 4 different appraisers on a refi, let's say, where there's no purchase contract or anything, and you'll have probably 3 or 4 different values. So it's kind of all over the board right now. And I do like the idea, sorry, our appraiser friends, of standardizing values and ranges and things of that sort for census tracts or square footage or whatever, some type of, hey, they might do a physical inspection, but standardize what the values are, or give a range for that based upon the square footage. Because, I mean, the inaccuracy sometimes between appraisers is crazy.
Yeah, I was going to say that there's a lot of reasons why lenders utilize appraisals. It's not just for the value. A lot of times, a lender, you're lending money out and you're not seeing the collateral, right? If you don't get an appraisal. So you have no idea what this house really looks like, what the structure of it is, and you're just going to lend money and hope that your collateral, if something happens, that you can get your money back, right? So an appraisal is not just about value. A lot of times they use these appraisers as their eyes and ears on the street to inspect the house, make sure it's still standing, make sure that in the 8 months since you bought it, you didn't destroy a whole room and now you're trying to get more money to finish it. But if you don't finish it, now I'm stuck with a house that's half completed that I can't sell. So there's a lot of reasons that you get an appraisal done. It's almost always to protect the lender, not necessarily you.
Yeah. So, I mean, VA and FHA do this streamline refinances, right? Where essentially you already were paying PMI, right? You were already not with a VA loan. You already had no equity, right? So essentially they allow you to do a no income, no asset refinance, right? As long as, you've been current on your mortgage or whatever. So I think it'd be interesting and streamline things a lot if Fannie Mae would do that, right? And if you're trying to maybe potentially get out of PMI or into a lower LTV bucket to lose that, okay, you need an appraisal if you got to take cash out. But I mean, wouldn't it make sense potentially from the investor standpoint that this person's just going to save money, so they can continue to pay their mortgage, just kind of like
they kind of did. They kind of did that with the HARP program. Not the same as an FHA streamline, but it essentially.
But it was very one-off. It was a one-off program.
Yeah. Well, HARP was to potentially save them from,
their own book of business. They were trying to save foreclosure.
7 years into their loan, and they can save $200 or $300 a month by doing a refi, going back on a 30. Yeah, I mean those made sense, and to a degree, as long as your income's still good. I mean, we're doing quote unquote streamline conventional refis, I would say. Bank statement, pay stub, mortgage statement, insurance, and that's it.
Yeah. So who should be looking at who should be contemplating refinancing right now? Like
anybody that has a mortgage.
Yeah.
Period, right?
Anybody that has a mortgage.
Even if you don't have a conversation about it.
You own your house free and clear. Think about it.
Take
some cash out.
No shit.
Anyone who's done a mortgage March or sooner or later, further back, right? Because I think after that, March or April, you should have a pretty low rate, very low 3.
Maybe
you should.
Depends, right?
Anyone above a 3 1/4.
I think everybody should at least talk to someone. Everybody should talk to someone. At least have a conversation.
Question. I get questions all the time, and they're already in the 2s, and I'm like, you're not there yet, right? But if they drop further, I'll call you. But yeah, I mean,
have a conversation about it. You know what I mean? So, yeah, guys, that's it. I mean, the refinance market is really, really, it reminds me honestly of when I got into the business. And I mean, this is a true refinance boom. Just if you're looking to refinance, just work with someone that's going to take the time and figure out what's best for you, and not just, what's best for their pocketbooks, because there's a lot of greed happening right now. It's a money grab. And those that are greedy are just looking at transactions. And I think that's the wrong way to do our business. That got us in trouble. I'm worried, just so you guys know, I'm very uncomfortable with the amount of activity that our business is getting right now, because when you start getting these numbers, it creates a lot of situations where people want to now do more fraud on the origination side, or things aren't being looked at like they were because things are flying through the system, right? It gets sloppy. Things aren't being caught. It terrifies me, because it feels like it did back before the crash where, Big Short, in that movie, Sal, where they come out and the douchebag loan officers are in their Maserati or like yucking it up, right? Like I'm feeling that air again in our market.
Money, right? I mean,
it's easy money,
to make
right
now if you're a loan officer, and you can kind of articulate to people that they can save money, right? And you can help them out, and you can either do it really well, or you can, that you still make a lot of money, right? But you can either do it really well and just help people and get referrals, or you can just kind of, be a snake about it. But I mean, that's always going to exist, I feel like, in this business. But
what I'll tell you as a consumer, Google your people, look into them. If if they don't have any, you know what I mean? Look into the person you're working with. What is their reputation in the industry? How long have they done it? Look at their LinkedIn. These people are going to be handling a very large financial transaction for you, right? What company do they work for? Is the company, do they have integrity? Like, you got to do that.
I think what I'm worried about right now is how quick everything is heating up, right? From a capacity standpoint of processors, operations staff, loan officers, these companies are growing to all-time big numbers, spending tons of money on infrastructure and whatnot. And let's say rates remain low through 2022, right? There'll be people buying and rebuying all throughout this time. But what about after that? And I mean, I guess that's just a part of every business that's cyclical, right? But like,
all of a
sudden you got to lay off, 1,000 people, or you're.
Yeah, Sal, there's a lot of bloated companies there's a lot of bloating right now because people have to handle the demand, right? But what happens when you refinance all the loan? I mean, it's like being a parasite and eating the last little bits of the carcass. Like, at some point, the carcass is going to be gone, and the only people refinancing are people that are nobody refinances.
Maybe they're coming out of a
cash out, right?
Or something like that. People who didn't qualify before, now their taxes are good. Whatever, right? So yeah, I mean, I think that's going to happen, or when rates go up and all of a sudden, there's not as many refis. Now every person.
So what happens to all these loan officers? Sal? What happens to all these shark loan officers that buy leads and hammer people over the phone? Like,
they're going to be probably in a pretty tough spot, and we've seen it before when rates spiked up, right?
Yeah,
and they have in the past 3 or 4 years that we've all been working together. We've seen rates spike up, rates go down, and when they spike up, you better hope you had some relationships to help feed you, because essentially, what are you're going to be calling leads to do? What? Hey, you want to take cash out? Which, if they're expressing interest in that, great, right?
Hey,
but if
by any chance, are you getting divorced and need to refinance?
Yeah.
I mean, I can imagine the phone calls, man.
Yeah. Well, listen, there's always a spot for someone to do what we do, right? Like, what in some factors, whether it's cash out, purchases, rate and term refis, there'll always be people who will be doing all of those things. But right now, if you're serious about either utilizing the equity in your home or taking advantage of it, do it, because it's not going to last forever. To our conversation that we just had, right? Like, the rates will go up. They have to.
Yes. Yes. Well, they don't have to. We could be Rome and we could just completely collapse. So
rates have to go up.
Yeah, that'd be the other side of it, right? So, guys, I'm going to leave you with one question. If you could be one of the other hosts, who would it be and why?
One of the other hosts?
Like, you have Sal or I to pick between.
Sal. 100%.
Okay. Sal, who would you be?
Man, that's tough, bro. I'd be like the actual, like, computer host, so I could know.
No. I'm talking about out of us three. Oh, you're talking about no. Out of us three, you got to pick between Brad and I. Who would you rather be, Brad or me?
Dude, that's like, someone's gonna get hurt.
Yeah, that's how it works.
No, I think I would probably want to be Paul, but I would also sometimes want to be Brad. I don't know. I mean, I think that
I would never want to be.
I would want to be Paul because you're small and nimble and whatnot, right? And then I like to be Brad because I'd have like caveman hands and could like smash small, nimble people.
Club
like
people.
So
you could
yeah.
just smash things, right? Yeah.
So
Big man.
It's a mixed answer. Right? I wouldn't say if it was permanently one of either of you, I would cease to exist.
No. Permanently. Who would you rather be permanently?
Dead.
That.
Sorry. No, I don't know. I would probably
rather be Sal. I would definitely rather be Sal.
For sure.
I think I would long term maybe be Paul because like a small dog, like your heart and whatnot will probably go longer. You know, like
thank you. Yeah, I got more longevity, right?
I think I mean, you got good genes. I mean, you look younger than I do.
Yeah. Man, all right, boys. Listen,
I mean, that cough is tough. Sometimes.
Yeah, it's fine.
Yeah, you're not healthy, man.
No,
you're really not. I mean, you're really not. Are you? You're not living. You don't move. Like you're the old guy in the recliner that doesn't move
because they're still on this show. I can't stand up.
You can't stand up anyways.
I think that's Brad saying, all right, let's quit bagging on him and let's
all right. Sorry, Brad. We love you, Brad. Listen, guys, thank you for listening to the show. Hope shed some light on refinancing. And wait, what do we got here? Thanks for doing this podcast, guys. No problem. Thanks, Chad. Chad said, thanks for doing the podcast, guys. Very informative for the consumer. Awesome, man. We really appreciate it. I mean, we're doing our best to try to get you guys the message out there. Hopefully we shed some light on some things. There's so much we could talk about on the refinance side. If you guys want us to do another show on this, reach out to us. Go to irbpodcast.com, shoot us a message there.
Or just call us.
Go to our Facebook or call us. Our numbers are out there.
If you I'm not listed. Like for you, call me.
Yeah,
call Sal. Or it doesn't.
Call. I mean, honestly, and we don't care if you're out of the country. Like we'll answer your call and we'll let you know. We'll try to help you out.
Well, I don't think we can do your
not out of the country, out of the state. I mean, I did a different state.
Okay.
Anyways, all right, guys. Thank you so much for doing the show, guys. You guys for listening, and we will see you next week. Bye.
Bye.